Hi, in this video, we'll be talking about market structure. I've explained quite a lot in the last three videos, but I'm moving to do some active work on market structure. I believe you can see my screen and I would get to it. All right. So first assignment here is on gold, ZAR USD. Now, I want to spot out some ranges, show you how to mark your trends properly. So better if I had done this on TradingView, but I believe, let me see if I can. Okay, this is beautiful. So I can actually work on this. Now, trend started here. You can see price dropped out on my drawing. All right, so price dropped from this point down here. You can see there are several Marubozu candles in this first pulse. So this is a valid pulse. There's no range on it. Now you can see from here, price pulled back up until this point. This is also a valid pullback. Then we have price coming down. This is not working out for me. Let me see if I can make the line right. Okay, this is better. All right. So price started from here. You can see price dropped to this point, and there's several marbles in this pulse wave. And you can see this is a valid pulse. Now, this is a pullback wave. You can see one marble, two marbles. So this is a valid pullback. There is strength in the pullback. Now, this the third wave is the third pulse. Is also a valid pulse because you can see from here the first Marubozu, the second one as well. So two Marubozu candles. You can see this first Marubozu candle, the second one failed, this pin bar failed, but this third candle confirmed using price action confirmation. So when we create price action confirmation when one of the candles in the pullback or breakout wave fails. So this one Marubozu and one small candle. But this candle is very big. So you can see this candle confirmed this pullback pattern. Now, from here onto this point is a valid pullback. Now, we want to judge if this is actually a valid pullback as well. Now, you can see this Marubozu candle here created a range. You can see price were closing within this first Marubozu. So this is a range. So this is the highest level of the range. You can see this Marubozu candle closed above this highest level. You can see above it. Second one closed here, two Marubozu candle, and we don't really care about the percentage of the candle that closes since it's two Marubozu candle. If it was one Marubozu and one small candle, then we have to check if top 30% that close above this breakout line, okay? But since it's two Marubozu candle, so long price closed above it, we are fine, and price close again. So far we established that this is a valid pullback. This is a valid pullback as well. So this is a valid market structure, okay? First wave, pullback wave, and breakout wave. Now, price pulled back here again, the continuation of the move. So from here, you can see there's a little range, but price broke out of the range, and this a clear or a strong move. So all the way down to this point. Now we have a range here. This is a Barabozu candle, and these two candles close within it. This, so they all close within. So this is a range at this point. But price, let's see if price broke out. This is a range. All of this is a range. But price broke out here. See these two candles, this, sorry, from the lowest level of the range. So you can see price broke out of the range here. Then price pulled back with this valid pullback. Then this a valid pause as well. So you can see in all the pause, this is the first pause, second pause. So you can see there's strong marble current that is showing you that price is actually moving strong. You can see price broke out of the trend at this point. So price has changed trend here. So I will just do like 3 cases, then we'll be done with this assignment. Because you can't do all of them. Now this NZDUS, you can see from the start here up until this point. Yeah, Marabozu candle. So this is a strong pulse wave. And from this point, there was a little range here, but price broke out of the range with this Marabozu candle and this one. Okay, now all the way here. So this is a valid pullback. Valid pullback. Now this is a strong wave. You can see there are several Marabozu candles in this wave. From here, you can see up to this point, Marabosma. So literally, there's no range here. Only there's a range. This candle was broken out of the range already. So this is a clear wave. Now, from this first pose, pullback pose and third, you can see that this now is our key level. Okay, these are key level in this market. Now, you can see price came into the key level later, and price is already reacting to it. If you were to buy a cruise, place your buy order above the key level and sell order just below it, and you would have bought from here. Now, after price created this structure, price pulled back and pulled back. So all of this was just a range, which does not really matter. What matters is your key level. Once you mapped out your key level, you have to wait for price to come into your key level, then you can buy from there. Now, case 4, from the start here, from the start of the wave, you can see there are several marble candles, so it shows that this is a strong pulse wave. Now, for the pullback wave, we have a range here. Price hasn't broken out up to this point. Price did not break out. Price did not break out. So price didn't break out of the range. Price is still in the range up to this point now. So at the bottom here, you can see that here is a breakout. Still is the lowest level. This is a breakout of the range. Because this Marabozu candle, and this second candle, this is one big Marabozu and one small candle. Remember, I have to count the last 5 candles, see if this is a big Marabozu candle. So this is a Marabozu candle here. You count 1, 2, 3, 4. 1, 2, 3, 4, and 5. So you can see this candle is very, very big. So it's a big Marabozu candle. That's valid. But this second candle is supposed to be small, but you can see it's big. Also to enter 50% of this candle, but it did. And this candle has the different color. So price was supposed to be like 30% of this big one, but this second candle failed because it's more than 30% of the big one. So we have to use price and confirmation. So if you count from this one, just the first candle closed above the original low of the candle. So you can see that this is a price and confirmation of this breakout. So this is a valid breakout. So this is a valid breakout. Now remember what I said about having a range in your pullback. We established that there was a range at this point. But since there's a pullback here, all we need to do is to look for the highest level of the range, which is this level. Map your key level from here. So you map your key level from here up to this point. I see that price came into it and dropped strongly. Okay, so this is your key level. The price came from this point, pulled back, valid pullback to this level. Then price came into it and dropped all the way down here. You can see there's a key level that price reacted to because price broke out. So assuming price didn't break out of the range, assuming this range was like this, and it extended to this point, this would have not been a valid key level, and price would have just broken it. Some market structure looks very easy, but some are very complicated. So I'll try to look at complicated ones as well. Let's see if I can shift this. Okay. So this is a strong Marabozu candle. So say if two lows are equal together, just start from the second one because it's the same thing. So just start from here. Starting from here, you can see that there are several Marabozu candles here. So that is a strong pulse wave, strong all the way to this up to this point. Now, from here now, you can see this big Marabozu candle. Hands are closing inside. So this is a range like this. Yet to break, yet to break, yet to break. So all of this now is a range. Let's see if price broke below. So this is the lowest low of the range. This candle, this price hasn't broken out. So price hasn't broken out at all. So now this was the start of the wave. The start of the wave here. So you can just map it as your key level. The price is already coming to it. So all of this now is a range. If you draw it as key level, because you didn't study market structure properly to say that this is not a this is a range, that you'd have gotten stopped out if you bought from this level. Very important. All right, so now cases. Let's see this strong wave. This is a pullback. So you can see this candle is big. Oh yeah. This a strong pulse wave from this point. Now price pullback here. The first candle is a Marambozu candle. Second candle is a pin bar. Third candle is a Marambozu candle. So this shows you strong continuous selling pressure. So this is a valid pullback pattern. So just draw to the bottom here. Now from here, Marambozu candle, strong wave. So show you this is a valid breakout. So the key level will be this point here. So you can see price came into it and bought strongly. So just trading with key levels alone will give you good risks to reward and very good trades. Now let's look at this. Start off with a range from this point. There's a range here. Price has broken out of the range with this Marambozu. So the valid breakout. And since price broke out of the range, you map the lowest level of the range you've done. I can see price came back inside and bought strongly. Price broke out of the range here, mark the lowest level here. Price came back and bought strongly. Now, if we take it from here, if there's a range here, range. Now price has broken out because price broke out from even here because one Marambozu, two Marambozu. So from here to this point, then breakout. Price moved up strongly. So now this will be our key level. You can see price came into it, price faked out a bit. But normally advise you add 10 pips to your stop. That would have covered this fake out and you'd have still gotten in strongly. Still had your strong profits. So I think I'll do 7 for this video then. And the next video I'll look at more cases. And let's go over to markets. Let's go back to market structure with gaps. Because most times when you're trading, you see there are gaps in your market. So I'll explain what is a gap, what's the meaning of gap, how do gaps form, when the gaps appear on the chart, what should you do with your gap, and how to analyze market structure with gap. Now you can see this this is a normal chart. Now you can see this open price. Bullish candle closes at the top. So price opens here and closes at the top. Price opens here and closes at the top. This is a normal chart. Now if you look at this, there's a gap. This is a bearish candle. Price opened here and closed here. Now price is supposed to open from here, the second candle and close here, but see there's a gap before price open this new candle and close here. This candle is meant to open up here. Let me show you what I'm talking about. This candle is meant to open from here like this to go down, but it came all the way down here to open. And there's a gap in the market. Now, why do this gap form? I want to explain that to you. See, this is the gap in the market. Now, gaps form if the market is on strong momentum. The momentum is very, very strong. Probably like if price is selling strongly, you can see there's a gap. Or market is strong, the market has very low momentum, meaning less people are trading, there's no much volume. So that's why you see gap as well. So you can distinguish if there's a strong momentum or if there's low momentum by looking at the candles after the gap. So if you look at this, then you can see that there was a strong selling momentum here. When some kits, you can see that there's just low momentum. So you'll be seeing a range along with gap, meaning that there's low momentum. Okay. Now, this NZD USD 1 minute, I can see that this is just showing low momentum in the market. So you can see gaps everywhere. Some pairs, you open their 1 minute, you see gaps like this. Means there are less people trading the market at the time. Now, why do gaps form? So, for example, you want to buy gold and the price is $2,500 per ounce. Now, someone is selling at this price, you want to buy here. But then, you want to still buy gold and there's someone selling at 3,000. But you buy gold immediately because you really want to buy it and because you feel that gold will spike in the future. So you don't really care the price that the person is offering. You understand? Just for example, you have, let's say there's four, you want to buy four. We own a filling station in Nigeria and you want to buy four. And you know that there will be first scarcity in the following week. And someone is telling you that let's say the current price is like 8,000. I'm not sure prices of foreign Nigeria at the moment, but let's say before is 8,000 naira per liter, and someone wants to sell for you for like 1,500 naira per liter, but you still buy because you know that in the following weeks price can go up to like 3,000 naira per liter. That's what this means. So you now see there's a gap from when you bought to when market now open at. You accept the higher price because you feel that price will increase. Okay, that's why there are gaps in market. People skip and buy higher because they are sure that market price will go higher. So if you look at this is called an order. This is called a order book. Sorry, it's on Binance. Shows you the price of Bitcoin. People are buying, people are selling. People trade order flow. They look at this a lot. They don't look at charts. They look at this to monitor prices. Now, for example, you can see that all of this now are showing current prices. So if someone now wants to sell for like 97,000 and you are very sure that you are very bullish on BTC and a lot of persons now buy at that higher price, there will be a gap in the market because price skipped 97,900 and skipped to 97,000 from 96,800. If you understand. Now, gaps appear on chart when there is low volume on a particular trading asset or time frame. Can also appear when market is changing from one session to another session. So, for example, maybe like 12 p.m. or whenever price changes session, you can say there will be a gap, or maybe in the new week, so there's a gap as well for market to change session. Now, these are trading sessions. You have to check wherever country you are in. If you're in Ghana, Cameroon, you have to check based on your time. You're in Berlin, wherever you are, you have to check based on your time to know when is the Universal New York Open or Tokyo or Sydney session. But there are majorly four sessions in New York, Tokyo, Sydney, and London. But people look at New York, London, and Asian. These two are Asian sessions. Okay. Now, What should you do with gap? Now, if there's a gap in the market, you have to analyze market structure to monitor the trend. Okay. So if there's just a few gaps like this, or just few gaps, just continue your market structure. Just assume that this is a Marabozu candle. This gap is a Marabozu candle. Okay. Assume that is a Marabozu candle, is a big candle that is this gap, and continue trading. But if now there are too many gaps, you have to just open a higher time frame. For example, if there are many gaps in 1 minute, open 15 minutes or 1 hour, and you can trade properly. But if there's still gap, just skip that pair and trade another asset. Get. Now, like I said, if there are just little gaps, like a few gaps, assume that the gap is a Marabozu candle, you need to just check your market structure and continue trading. Now, also you have to wait for price to get to your, let's say, 15 minutes buys or 15 minutes key level. You have to wait for 5 minutes confirmation to buy. You understand? Now, if there are too many gaps, just keep that time frame, go to a higher time frame, or skip the pair. It is 1 hour gold. You can see there's a gap here, but we don't really care. We just continue mapping our structure where we should. So let's try to map out structure on this. So let's go from this point to this point. I see that this is a strong down pressure. Now, this candle has already created a range. This big pin back candle has created a range here. So you can see price broke out of the range with this. So this a valid key level. Okay. But you can see there was a gap here during the breakout. This is a range. But price broke out and there was a gap before the price broke out completely. Now price came lower, all of that. Price came back to this key level now. You can see that price faked out strongly before price dropped. Because this gap is here. That's why price faked out like that. This gap is here, like this. This is the key level. Price faked out strongly at this top because of the gap that is here. So price can react like this to zones that has key level that has a gap in a pulse wave. That's the essence of this. Now, let's go over to multiple time frame analysis. Now, multiple time frame is for you to build a logical multiple time frame system. Know how many time frames you should be trading and the function of each time frame. Now, persons trade 1 hour, 15 minutes, 5 minutes. These are a lot of time frames, and you don't need to trade this much time because you'll be overloading yourself with too much data. Okay, one M15, M1, M15, 4 hour daily. These are also too much. So you have to focus on 3 time frames or 2 time frames. 1 hour, 15 minutes, and 5 minutes, or this. Currently, I recommend you trade with this because this is what I use. This works very, very fine. Okay, just 3 time frames or 2 time frames. Now you need to have the base time frame that you use more, or time frame that you get your market structure from to enter and all of that. But it's based on your personality and the way you are. I'll explain that shortly. Now, if now you want to enter a trade, you enter a trade and market goes against you strongly and you face bigger loss than you expect. If you stay calm and stick to your discipline and cut the loss immediately, you can trade any time frame because you won't feel much emotions if you're trading slow time frames and price moves against you fast. You can trade low time frame. But if you hesitate to close your losing trades, it's best you trade on M15 and higher time frames. But if you can discipline yourself very well to cut loss fast and all of that, then you can trade anytime. You can trade 1 minute time frame even. But if you are still working on yourself, you can trade from 15 minutes, 1 hour, and 4 hours. But if you panic and close your trade quickly to avoid further loss, then you trade on 1 and 4 hours and 1 hour. If you panic easily, also about emotional management. So just pause this and read through, see kind of person that you are. But let me summarize for you. If you're a newbie, or rather, you're not a newbie, you're just learning the strategy, you've been training for a while, whichever way, just focus on M15 and higher time frames. Communicate 4 hour and higher time frame, but you just have less opportunities with this. Because 1 minute, 5 minutes, 1 minute especially, would take a toll on your emotion and psychology. Now, if you're using M15, you have 5 days to get one chance with your strategy. Like I said, if you're using 1 hour and 4 hours, you have lesser opportunities, but you won't be prone to some emotional mistakes. But if you think you're using M15 1 hour, then you just have moderate opportunities, which I recommend. Now, M1, you have 10 chances in a day. It's a lot, but you can lose most of some of those chances. Just major toll on your emotions. Now, if you're using M15 with me, M15, 1 hour and 5 minutes, your base time should be your M15 time frame. Now, you can have a sideline time frame with your 1 hour time frame, with your higher time frame, 1 hour. You can have lower time frame that's like 15 minutes, sorry, 5 minutes for confirmation. So one hour is where you get your bigger picture. M15 is where you get your market structure, while M5 is where you um do your confirmation to enter. Now, like I said, M15 to analyze market structure, your zone, your key level, and all of that. 1 hour is where you check market condition, you check where to take your take profits, you understand. Then M5 is where you confirm your entries and also trade your stop loss. So this is what I recommend. 1 hour, 1 hour, M15 and M5. Okay, so that's it. Now, if you want to understand this more, pause the video, watch it. You get pause the video and watch it, and read through. But I've already explained. I believe my explanation covers it. And market structure rules and multiple time frame theories. Now, if you map your M15 up structure like this up 50 up key level, there can be an M15 down key level as well. But it's the one that is in conflict with the trend. If M15 is an uptrend generally, then this up key level has higher chances of holding. Although this key level, don't neglect it. Okay, this is also a strong or a risky zone. So when the price gets there, you can put your stop loss at entry to see if price will hold it, price will break it or not. Now, if you want to confirm the M15 key level now with a 5 minutes time frame, on join 15 structure like this, and you have M15 down clear, you have to analyze 5 minutes down structure from this M15 down wave here. 5 minutes is from here to this point. Now, if price can confirm in 5 minutes, then price can break this M15 down key level. I'll explain these things properly on live chat when we do our backtesting together. Now, 1 hour time frame, this is how you won't start analyzing. You have to first map key level in 1 hour time frame. Just check 1 hour time frame, map your current key level in 1 hour time frame. Once you mark that, you can now, this wave that moves from 1 hour to this point is your 15 minutes trend. Can I map 15 minutes structure? If you give M15 key level here, when I have M15 key level here, you can now map away for 5 minutes to confirm here. We'll explain this when we go on live chat in the next video. Now, when you have an up structure like this and price comes down this level, forget about what is here. Analyze this down structure differently. Analyze here differently. Analyze here differently. If there's a range in these points, don't care about it. Just focus on this down move. Okay. I'll also explain this on live chat as well. Now, M15, this 1 hour up key level. here now you have M15 up structure inside this 1 hour up pulse wave. Now, if M15 moves here up to this 1 hour up key level and price touch this 1 hour down key level here, means that M15 up move has come to an end and price can break M15 structure and come down to 1 hour up key level. Now, M15 key level, M15 key level. And if price comes from here to 1 hour up key level, there's a higher time frame key level, then price can change trend. That's what I mean. So if price tap this thing now, price can come and break M15 down key level. Price can break it and price will go to 1 hour up key level. Like I said here, look at this. 1 hour M15 can be here, price will break it and come to 1 hour. So the same thing as here. Price break taps 1 hour down key level. M15 will break structure and go to 1 hour up key level. So I will explain this multiple time frame analysis probably in this 2 time frame. I can even leave this because this is very, very advanced and you may not understand. So let's just focus on this. Let me go over to Genevieve and show you what I was explaining. Now, on TradingView, I will just explain multiple time frame a bit, and I believe persons who have little idea about this before will not be so confused. Although I will still try and explain it more. Now, 1 hour can be an uptrend like this. This 1 hour uptrend, marking it with black. 15 minutes will be like this. For the 1 hour time frame, you will just see that it's just a straight uptrend. For a few minutes would have changed trend to downtrend here and change back to uptrend here. With multiple time frame analysis. Now, how does this work? You know, in 1 hour time frame, every candle is made up of 1 hour. But in 15-minute time frame, every candle is made up of 15 minutes. So there are more candles in 15 minutes time frame than in 1 hour time frame. So when you're seeing just straight 3 candles in 1 hour, that means they're up to like 6 to 10 candles in 15 minutes. Now that those candles will be showing you an uptrend in this 1 hour straight move, downtrend here and an uptrend here. How is this important in market structure? When you have 1 hour up like this, let me mark this one today. This 15 minutes structure. So 1 hour up level like this. 15 minutes now will not be on an uptrend from this point. So you know you can mark 15 minutes key level and buy from here. Price goes higher. Okay. Now if you want to confirm this 15 minutes level now, let's say what price comes with 15 minutes key level, you want to confirm if price if to hold. And 15 minutes has a pullback like this and a valid pullback and a down move. Now this down move now is where 5 minutes structure is. So 5 minutes can be here like this. 5 minutes to break the recent BOS and go higher for confirmation to happen. Let me change this to 5 minutes color. All right. I think my internet disconnected for a bit. So I said just look at this. This up move now is 1 hour. The black one is 1 hour. Say 1 hour move now. That 15 minutes uptrend. Means uptrend created 15 minutes key level. Yeah. Means up key level now. We have 5 minutes down move. This 5 minutes. So when 5 minutes comes into 15 minutes level, 5 minutes can create his own key level that he uses to buy. But forget about the entries for now. Just focus on how multiple time frame analysis work. 1 hour is a straight wave, 15 minutes is an uptrend inside 1 hour straight wave. Then 5 minutes is in a downtrend inside 15 minutes wave. So watch this over and over again, and I believe you get it. Thank you very much.